Are we done seeing bank failures here in the United States? Earlier in 2023, we saw two major banks, Silicon Valley Bank and Signature Bank, fail. Now, these were the second and third biggest bank failures in US history. And some might have thought that the worst was behind us, but is it actually? Or is there another potential banking crisis that's lurking out in the future? The reality is that the commercial real estate space is still trying to sort itself out. Now, I don't know if it's going to happen fast enough in time to prevent another potential banking crisis, but interest rates and the current trajectory that they are on and what happens with them in the future, coupled with what is going to become of so much commercial space around the United States, particularly in major US cities, is ultimately going to determine whether or not we've seen the last of a bank failure for several more decades to come, or if there are going to be more. So we've seen plenty of turbulent times in the banking space over the last couple of years, but they may only be beginning. And now with a little bit more of a unique twist. Let's take a closer look at New York Community Bank, which just recently saw a huge clip of its value be drastically reduced in a matter of days. And this has started to raise the concern that more bank failures could be on the horizon. Take that and couple it with Jerome Powell's comments recently about smaller or regional banks potentially closing due to plummeting real estate values around the country, but he's specifically talking about commercial real estate. So which banks are actually going to be vulnerable, and how does this affect you and I, and what ultimately can we do about it? Today's video, we are going to find out how to actually see what's going to happen there and what can be done to make sure that we're protecting ourselves on a personal level. But before I get into some of those details, allow me to quickly introduce myself and ask a favor of you. My name is Arjun Dhingra. I put forth a lot of content around these types of topics, as well as general real estate related media, so that I can help people make better decisions around taking out mortgage debt. I've been very passionate about this topic for the last 23 years, and it would mean a lot to me if you would click to subscribe to this channel so that I can reach more people like you, and also like this video so that we can make sure it reaches more individuals. So let's first break down how banking actually works in the United States. Banks here operate on a fractional reserve system, which means that they only keep a fraction of the deposits that you, as someone who has put your money into a bank, to be available for withdrawal. And what they do with it is actually take it and invest it. This is what has always generally kept the US banking system quite healthy and very fluid with cash, but it also during strange economic times could lead to its demise. So imagine this, you deposit $1,000 into a bank. The bank will only keep a certain percentage of that and then take the rest and lend it out to others, thus stimulating the economy through more borrowing and the ability to invest, pay others, purchase goods and services, etc. On paper, it works beautifully because it facilitates loans and allows for the ability to earn interest on those deposits. But it's also based on a high level of trust and also the understanding and hope that not everyone is going to want their money out at the same time. But here's the twist. During 2020 and 2021, the 0% interest rates meant that a lot of money was flowing back into banks. And rather than sit idle with all that cash, banks were taking this money and investing it at a fast clip or re-lending it out. In many cases, out to would-be commercial property purchasers and also into low-yield US treasuries. This was all fine and dandy until the music stopped or the Fed started to raise interest rates. Normally, this would not be an issue, but for the smaller and regional banks, it hit them very hard. Because when this happens and then a few dirty rumors start on Twitter that everyone needs to start pulling out their money, you have what is referred to as a run on the banks. Meaning everyone lined up outside, like we saw all those images of pertaining to Silicon Valley Bank, wanting to get their cash out because they're afraid it may not be there or the bank may just close their doors. So this massive withdrawal led by all of its customer base ultimately led to some of these banks actually closing their doors because they had a huge liquidity crisis on hand. Obviously Silicon Valley and Signature Bank, but also and more notably First Republic Bank, as well as Citizens Bank of Sac City and Heartland Tri-State Bank. So again, back to the huge withdrawal. When you have everyone basically pulling out their money and the bank doesn't have the money to give, at some point they just have to wave their hands and close down. So what does all this mean? When all the banks were investing this idle cash into low yield treasuries, they recognized that these treasuries were offering very minimal return. So then they started and turned to commercial real estate because there was a huge boom going on in that space, just like there was in residential real estate. But valuations of commercial properties are arrived at completely differently than you see in residential. And when you see a big spike in lending rates, you start to see also a huge devaluation of these commercial properties and a crisis that could resemble something similar to 2008. Currently in the United States, roughly 2.7 trillion with a T dollars is held in commercial loans. But most of this is actually carried by small or mid-sized banks. And these types of loans are extremely different because unlike traditional residential mortgages that are typically fixed for 30 years, these commercial loans reset every 3 or 7 years. So now that interest rates have been rising again post-pandemic, we're starting to see the valuations of these properties tank and the cost of these loans at the same time skyrocket. So I know this is a lot of economic slang, but here is how this affects regional banks. As of late, they are facing significant risk because the commercial real estate valuations are starting to drop and repayment risk is on the rise, meaning some of these people who actually are carrying these mortgages are actually starting to fall behind on those repayment plans. Huge banks like New York Community Bank, which I referenced earlier, as well as Deutsche Bank, have reported big losses in this area. One place that is being affected significantly is going to be office spaces. Remote work is a huge deal right now, and many companies have either downsized significantly or have completely reallocated how they want their workers actually functioning. And with more and more of them continuing to work from home, and in some cases indefinitely, the need for their offices is continuing to lack, which is leading to skyrocketing vacancies. In fact, vacancies for office buildings are at their highest level since 1979 here in the US. So you take this kind of vacancy for commercial buildings with office spaces. You also couple this with the fact that many small businesses in major metropolitan markets have closed post-pandemic because the way of living in life and business in those areas has changed dramatically. And this all spells major trouble for banks that are holding these types of properties or loans on their books. So what about all of us as regular folks? Most of us aren't paying particular close attention to this because we are not invested in commercial real estate or have any of our holdings tied to it. We're just concerned about skyrocketing costs of living, utility bills, groceries, etc. But what can we expect from now on? Well, the worst case scenario is that inflation does not get under control and that we have continued higher interest rates and eventually the economy gets pushed off a cliff into a recession of some kind. But on the other hand, Jerome Powell remains very optimistic about the economy's strength, and many Fed governors are behind him on this. He is continually trying to assure us that not all sectors of real estate are actually in trouble. In fact, some are even flourishing, like certain retail spaces which have made a big comeback post-pandemic and warehouses. Plus, most commercial real estate debt is still generating enough money to meet refinancing standards, and the delinquency rates are barely higher than pre-pandemic levels. So ultimately, the factors that could impact this, how quickly AI continues to come into major cities, particularly here in the Bay Area, and absorb a lot of this vacant office space. How quickly will other businesses start to force their employees to come back to work and start occupying those office spaces and raising the values of these properties in the end? But ultimately, my advice for you, if you're thinking about making an investment in any type of commercial real estate or business, is to take your time, really evaluate the offer, make sure that you're working with pros, do your homework, and do not be afraid to come in with a lower than market offer. And for those with funds in smaller or more regional banks, be aware of the risks despite all of the FDIC coverage or guarantees on your money that is deposited with that bank up to a certain amount. But the main thing is make sure that you always seek advice from professionals in any space, whether you're buying residential or commercial real estate. Advisors that have been through a few different types of market cycles and understand what's going on in the macro economy, as well as have a clear understanding of what is happening right now with regard to the US banking system. Because personalized advice that is backed up by sound data and experience is what's going to ultimately help you in making the right decision. So we're going to have to watch and see what happens to the overall economy and ultimately what the Fed decides to do. I think it is fair to assume that any more rate hikes, which are certainly not off the table considering where inflation data has been coming in as of late, could potentially cause a few more banks to fail and push the economy into some form of a recession. But rate cuts could inject a lot of capital back into the system, get money flowing around, and probably insulate some of these banks from what would be a really catastrophic ending. Time will tell. We'll continue to watch what happens to the overall US economy, particularly in an election cycle, which is certainly going to play its role, as well as monitoring other aspects of what's going on in the broader economy. I hope you found this video useful. If you are thinking of making San Francisco or any part of the Bay Area your home, make sure you check out my website at arjundhingra.com for more information and resources. You can also contact me on that website, and it would be an absolute honor and privilege to be able to answer any of your questions or even help you out with this move. You will absolutely want to download my San Francisco relocation guide, which is in the description below. Again, please make sure to like this video and subscribe to my channel so that we can reach more people like you and also continue to provide you with content like this about the broader economy as well as home buying and investing tips. I hope you enjoyed this video and I look forward to monitoring this particular situation for you and seeing you on the next one.